In this week's video, we'll review the latest charts to help us answer the question, how stable is the stock market? We'll be moving quickly, so feel free to use the pause button on your video player. It's a slide from last week's video, and you may remember we talked about this headline here from last week. S&P 500 tumbles Friday to post worst week since 2023. NASDAQ drops 2% for worst week since 2022. Often when you see headlines like this, a week later, you may see the polar opposite. If we fast forward 1 week, the educated or probabilistic guess from last week was accurate. Headline this week, S&P and NASDAQ rally Friday to cap best week in 2024. And during Friday's session on September 13th, the advance was extremely broad, and some of the data, including new highs versus new lows, posting much improved looks. It's a daily chart of intermediate-term Treasury bonds relative to the S&P 500, IEF relative to SPY in the ETF world. We're looking at the 8-day moving average in blue all the way out to the 50-day moving average in gold. Thus, it helps us with the short to intermediate-term trend. Hypothetically, let's assume you had a large amount of cash to invest today, and you were trying to decide whether you should allocate your resources toward the stock market or should you buy bonds. And the movement in this ratio in the coming days will also help us with the risk-on versus risk-off question. This is early November of last year. You can see the ratio of bonds to stocks drops below the moving average cluster. The 8-day moving average drops below the other moving averages, and this is happening as the S&P 500 is bottoming. The S&P 500 bottoms right here in late October of last year, and as this ratio starts to fall, that's decreasing fear. Thus, in the present day, to feel more confident about risk on and to feel more confident about the economy, we would prefer this look over here on September 12th to morph into something more like this over here. And this will be a common theme in this week's video. In this ratio, again, bonds relative to stocks, we had a big spike in fear on August 5th. The second spike in fear that we had last week, you can see it wasn't as great. This is a lower high relative to this high here, telling us we should be open to this ratio taking on a look like this in the coming days. And at that point, it becomes easier to make decisions about asset allocation, and that includes if you're a relatively new client in terms of potentially reallocating your portfolio. This is DIA, the Dow Jones Industrial Average ETF. This is 2020 back here. This is the bear market here in 2022. Thus, this would be the look that we would want to avoid if we're long stocks. You can see in the present day on the right side of the screen, this really doesn't look anything like January of 2022, and it looks nothing like February and March of 2022. And in this case, we're using the 20-day moving average in blue all the way out to the 250-day moving average in black. And in terms of being concerned about a significant drawdown and/or a recession, this chart has a full-bore bullish look with price above all of the moving average, blue the fastest moving averages on top, black the slowest moving averages on the bottom, and the slopes of all the moving averages are up. Fair question might be, should we be buying DIA? Under our approach, the answer would be no. This is now a weekly chart. This is DIA relative to VU, the S&P 500. And in this case, we've got the 20-week moving average in orange, the 30-week in blue, the 40-week in green, and the 50-week in pink, all the way out to the 200-week moving average in red here. And you can see the ratio of the Dow Jones Industrial Average relative to the S&P 500 index remains in a downtrend. Fastest moving average, the orange moving average, is on the bottom. The slowest moving average, the 200-week, is on top. And the slopes of all the moving averages are down. We would have a full-bore bearish look if the ratio were to drop a little bit further into this region here. That would be the bad news for DIA relative to VU, or the Dow Jones Industrial Average relative to the S&P 500. Again, the good news is the trend in isolation looks fine. This is the long-term period of consolidation here. This is calendar year 2023. This is a bullish breakout here that occurs above that 250-day moving average in black here that's starting to turn up in a confident manner. When you get to this point in here, the market needs to consolidate its gains. It does that in this second blue rectangle. And in recent weeks, it's been consolidating above this rectangle and above this rectangle. How about inflation? What is the market thinking after this week's CPI report? This is calendar year 2022 here. This is also a ratio. It's energy stocks XLE relative to VU, the S&P 500. This is what increasing fear of inflation looks like. You can see the ratio pops above the 200-week moving average here early in calendar year 2022. And then right in the window where the stock market bottoms, the S&P 500 bottoms here in October of 2022. The NASDAQ bottoms here very late in calendar year 2022. You can see the market's concerns about inflation start to wane. And now we're almost on the opposite end of the spectrum. After this week's inflation data, that same ratio is dropping back below the 200-week moving average in red. This really doesn't look anything like this, telling us that at the moment, market participants do not appear to be too concerned about inflation causing problems in the coming weeks and months. Back to the weekly chart with the 20-week, the 30-week, the 40-week, the 50-week, and the 200-week in red. This is the ratio of the S&P 100 relative to the S&P 500. That's OEF relative to VU. And VU, of course, is basically identical to SPY with one exception, lower expense ratio. But this tells us that really mega cap is still trending relative to the S&P 500. In fact, with this look here, we do have that full-bore bullish look with the ratio back above all of the moving averages, fastest on top, slowest on the bottom. You can also see that we broke out of this consolidation box here and have been holding that bullish breakout for several months. All of this is occurring above an upward sloping 200-week moving average in red. And in terms of a big leadership change, we're not really seeing it. The equal weight S&P 500 RSP relative to VU, the S&P 500 standard weight. We have a sharp counter trend move here. We really don't have anything here that says anything has changed in a significant manner. How about growth stocks relative to the S&P 500? A nice run here in 2023 and into 2024 may have gotten a little bit extended. Now we're coming back to the trend. And yes, we've seen relative weakness, but we don't have a lot on this chart that says anything about a trend change. More vulnerable? Yes. And later in the video, we'll take a big step back to try to help us understand which way this indecisive look could break. Notice where the ratio of growth stocks is relative to the S&P 500. The chart is in the upper right-hand corner. For the most part, that's what we want. We want to own things that go from the lower left to the upper right. That is not the case with value stocks relative to growth stocks. Going back to early 2023, that ratio, value to growth, has been moving from left to lower right. And during the trading session on Thursday, September 12th, growth stocks were outperforming value stocks by almost 3.6%. And if we use different ETFs and flip it around, now we're looking at growth relative to value. The growth ETF, SPYG, outperforming SPYV value by 4.48% this week. But we do have this indecisive look in here telling us to keep an open mind. But thus far, the ratio of growth to value hasn't made a significant lower low, and the last thing it did was make a significant higher high, and we still have the 20-week in orange above the 30-week, 40-week, and 50-week If this ratio were to break into this area here, the longer it stayed in this area down here, the more concerning it would become relative to leadership. Thus far, the trend favoring growth over value that was established early in 2023 is still in place. How about utilities relative to tech? XLU relative to VGT. Has been a period of outperformance here. Utilities outperforming tech. But thus far, all of this is taking place below a downward sloping 200 week in red. And around 2:15 p.m. Eastern Time on Thursday, September 12th, utilities were underperforming tech by over 4% this week. If the ratio here in the lower right-hand corner takes on a look more like this, then bearish concerns would increase. Like many charts in the short to intermediate term, this does have an indecisive look and unquestionably has more of a defensive posture relative to anything we've seen in 2024. And that aligns with the concepts we presented earlier on this slide. We still need to see a little bit more relative to feeling more confident about the resumption of risk on. Dividend stocks relative to the S&P 500 underperforming by 2.55% this week. Right now, this looks like a counter trend move within the context of an existing downtrend. But it also has an indecisive look, telling us to keep an open mind in the coming days and weeks. Relative to some of these indecisive looks that we have, especially in the intermediate term, looking back several months, let's see how some of these relevant charts look on a monthly chart with the 50-month moving average in blue. This is value stocks IVE relative to the S&P 500. Right now, the downtrend here that's been in place since Q1 of 2023, a trend that's going against value stocks relative to the S&P 500, that downtrend is still in place. Right now, this looks like a counter trend move within the context of an existing downtrend and within the context of an existing long-term downtrend. The prospects for value stocks relative to the S&P 500 would improve if the ratio can get out into this area here and if the 50-month moving average can continue to turn up. Same monthly chart with the 50-month moving average. Now we're looking at small caps IWM relative to the S&P 500. This trend, especially the long-term trend, has a lot of work to do. Based on the chart in front of us, we're still making a series of lower lows and lower highs. All of this taking place below a downward sloping 50-month moving average in blue. In mid-September, it looks even worse for mid-caps. MDY relative to VU, the ratio is making a new low. Thus far, this looks like a counter-trend move on the chart of RSP, the equal weight S&P 500 relative to VU. If that counter trend is going to have some legs similar to this trend here, at a minimum, or a good first step, would be to exceed this closing high here, very, very similar to this look here in 2020. Right now, the chart in front of us clearly says relative downtrend. The same can be said for dividend stocks, SDY, relative to the S&P 500. On the leadership end of the spectrum, same exact chart, monthly chart with the 50-month moving average in blue. This is home builders ITB relative to the S&P 500. And unlike the downtrend charts, the relative downtrend charts that we just covered, all of this action up here in the ratio of home builders relative to the S&P 500 is occurring above an upward sloping 50-month moving average and above this long-term consolidation box. There's no question in recent months the leadership in QQQ relative to VU has stalled, but the ratio is still above the 50-month moving average. And we don't really have anything that says that this relative push higher here from late 2022, that this trend is over. We can say this confidently. The trend of QQQ relative to VU looks better than this, looks better than this, and it looks better than this. Even more encouraging, SCHG growth stocks relative to the S&P 500 on a closing basis, this ratio has exceeded this high here from late 2021. All of this is occurring above an upward sloping 50-month moving average in blue. Same could be said for XLK. This is the bear market in here in 2022 when XLK was underperforming VU or the S&P 500 ETF. So we have a trend, a relative trend that's extended from the 50-month moving average. The market needs to consolidate its gains. Interest in tech picks up near that upward sloping 50-month moving average. And then the ratio went on to exceed the pre-bear market high. And all of this sideways movement and indecisiveness in here has been occurring above an upward sloping 50-month moving average in blue. And once again, we can say confidently that the ratio of XLK to VU looks a lot better than these charts that we just covered, including the ratio of small caps to VU, which is clearly in a downtrend. Now let's mix things up a little bit. This is the tech sector relative to the S&P 500. Now let's look at defensive staples relative to the tech sector. So now we're looking at XLP relative to XLK. This is calendar year 2006 all the way out to the present day. You can see in the financial crisis here, this is January of 2008. Look how this period of indecisiveness, how the ratio is popping above and below the 50-month moving average. Do we have anything like that in 2024? We do not. All of this is taking place well below a downward sloping 50-month moving average. All of this in here was telling us that this trend wasn't particularly strong in either direction, and eventually the ratio of defensive stocks relative to tech pops above the 50-month moving average and starts moving rapidly higher in calendar year 2008. Moral of the story, this here, January of 2008, really doesn't look anything like September of 2024. So we just showed on a relative basis, looking at long-term charts, value stocks have work to do. Small caps have work to do. Mid caps have work to do. The equal weight S&P 500 has work to do. And dividend stocks have work to do. Thus, what does it say about the health of the broad market when one of our underperforming ETFs, value stocks, basically looks great in isolation? This is IVE value stocks on September 12th, has a full-bore bullish look with price above the 50-day moving average in blue, all the way down to the 250-day moving average in black, fastest on top, slowest on the bottom, slopes are all up and price is above. This really doesn't look anything like this bearish turn here in 2022. So one of our weaker relative trends in isolation looks very good. This looks like a period of consolidation in here earlier in 2024 and then a breakout. Same can be said for small caps. The relative trend doesn't look great, but this is an improving look here in the present day relative to what we had in 2022 and 2023. All of this in here in 2024 has been occurring above an upward sloping 250-day moving average in black. Still looks indecisive, but it looks a lot better than it did back here. Everything that we just said about the chart of small caps applies to mid caps. Mid caps look a little stronger in that they have exceeded this high here from late 2021. And that's not the case for small caps IWM. They're really nowhere near this high here in 2021. So mid caps on a relative basis, they're a laggard. In isolation, nothing particularly alarming here. All of this occurring above an upward sloping 250-day moving average in black. Also looks like we've broken above this consolidation box, and we're consolidating above it in a healthy manner. RSP on a relative basis, we showed, really doesn't look that good. In isolation, it looks very good. What does that say about the entire market and the entire market's risk-reward profile when one of your relative laggards looks fine in isolation? Same can be said for dividend stocks. Long term, they're underperformers. Short term, they've done very, very well. In fact, it's possible that this is extended from the trend down here, and dividend stocks need to take a little bit of a break. But even if they do, it's not really going to put this breakout here in jeopardy in the short run. We could come all the way back down here and retest this level here, and the uptrend for the most part would remain intact. What does it say about the health of banks, the health of consumers, inflation, interest rates, mortgage rates, when ITB home builders in isolation looks this strong? Clearly began an uptrend down in this region here in early 2023, and that trend is still in place. QQQ well above the 2021 high here. Doesn't have a full bore bullish look, but it's close. The recent low last week well above the August 5th low here, showing decreasing fear. Still has some work to do, but this really doesn't look anything like this concerning look here in 2022. Notice how the 50-day moving average in blue here slashes through the other moving averages. That's not really what we have at all in the present day. And this low both found buying support in this region here above this level here. Everything that we just said about the chart of QQQ in isolation applies to the chart of SCHG in isolation. This chart just looks a little bit better and is very close to restoring a full bore bullish look. There's no question XLK has been weak, but all of this has been occurring above an upward sloping 250-day moving average in black. If this starts to morph into something more like this here, where the 50-day moving average starts to cut through all of the other moving averages, and price comes down to the 250-day as it did in January of 2022, concerns would increase. So you can see here we're unquestionably more vulnerable. If we move into this area here, we'll feel better. If we start to look more like this, concerns would increase. Right now, you give the existing trend, an uptrend, the benefit of the doubt. The last thing this chart did was make a significant higher high. It has yet on a closing basis to undercut this low here, and the last low thus far has not undercut the August 5th low. Looks like we've tested this level in here twice. Both times, buyers stepped in. And this is the chart of VU, the S&P 500 index in isolation. You can see the right side of this chart really doesn't look anything like this concerning rollover look in 2022. On September 12th, 2024, at the close, VU had a full bore bullish look with blue the fastest moving average on top, black the 250-day moving average the slowest on the bottom, price above all the moving averages, and the slopes are all up. Contrast this look here with this mess here in 2022. If the present day chart right side morphs into something more like this, concerns would increase. That may happen very, very soon, but it hasn't happened yet. We still have some good spacing between these moving averages, indicating what appears to be a still strong trend. More vulnerable? Yes. What could potentially push these tech-heavy relative charts to new highs? And what could potentially push XLK higher to end this period of consolidation? While we all know there are countless factors that go into examining a question like that, we continue to see story after story that speaks to significant future investments in AI and tech. And next week we have a Fed meeting. They're expected to cut rates by either 25 basis points or 50 basis points. And historically, source of this information on the right side of the screen, these two Twitter handles, when the Fed cuts interest rates in the context of an economic expansion, the average return 12 months later, 16.5%, with every single case higher. And that aligns with a study that we presented approximately a month ago in the August 9th video. in the cycles where the Fed cuts rates more slowly, meaning the economy is stronger and they're not in panic mode. And those cases include 1980, 1984, 1995, and 1998. 1 year later, the NASDAQ average gain 38.7%, median gain basically the same. 2 years later, average gain in the NASDAQ over 59%. And a week ago, when we were dealing with this headline here, our secular volatility model scores from September 6th told us to try to be patient. If we fast forward a week, the strong numbers from last week on September 13th look even stronger. Trend strength scores firmly say bull market. Which brings us to the major moral of this week's story. We don't want to get too cute worrying about leadership, especially on shorter time frames. We have a broad advance, and we're still aligned with the long-term leadership trends. Really haven't seen anything in the last 2 weeks that would change these bullet points from August 30th. They still apply. And until proven otherwise, we're going to give the secular bull market the benefit of the doubt. And we all know, if we're going to use this effectively, it's extremely important that we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.